Hi, I'm Vanessa Wieliczko, Chief Investment Officer at Wieliczko, and I'm joined here today by Steve Taddie, our Chief Economist. Today, we're going to be covering market performance for the first half and then diving into some of the key factors that drove that performance before launching into an outlook. So with that, let's drive through some of the performance numbers, and then we can, again, get into some of the factors that led to that performance. S&P 500, our large cap US stocks, were up about 4.3% for the second quarter. That puts them up year to date for the first half at 15.3%. Now that compares to mid cap and small cap at 6.2 and down 0.7% for small caps for the first half. International stocks, meanwhile, were up about 5.3% year to date, and emerging markets up about 7.5% year to date.
Now, those are some fairly big differences, Vanessa. What were some of the reasons behind the differences?
Well, we're seeing in the US market a divergence between small cap and large cap. And I think part of that is driven by the fact that small cap companies tend to have more variable rate debt. So you're seeing a reward to companies that have more debt coverage and more cash on their balance sheets, have fixed rate debt. And we're in an interest rate environment that is more elevated than it's been for the past decade. And clearly that's starting to impact some of those companies that have variable rate debt. On the international front, I think probably the biggest driver is the fact that international stocks indexes tend to have less tech exposure. And tech is really the big topic of the day, and it continues to be. That there is more of an expectation that productivity gains could play out across the market, simply based on that leverage of AI and new technologies. So I think that is a big part of the drive.
And under the hood of the S&P, it's a fairly tech-heavy index, no?
Yes, very tech-heavy in the S&P 500. We've heard a lot about the Mag 7. I think that's now shifted more towards the Fab 4. So you've heard about Tesla being one of the Magnificent 7. Year to date, Tesla is actually one of the worst performing S&P 500 stocks. Meanwhile, those top four, NVIDIA is one of the top performing stocks, and it also happens to be a very, very large market capitalization. So that itself is driving market performance. And you'll see that the concentration is getting higher and higher. Now, I've heard a lot of comparisons now to the tech boom and bust of the late 90s. So Steve, do you want to talk about kind of how it's maybe a little bit different now than it was in the late 90s in terms of what the underlying fundamentals are?
Yeah, the biggest difference, and something that you and I have talked about in the past, is the earnings. The tech bubble of the 90s was significant for the fact that there were no earnings behind many of these companies. The absolute reverse is true this time around, as a number of the tech companies make up a lot of the earnings and a lot of the earnings growth of the S&P 500. So it's a huge difference in terms of what's under the hood.
Okay, well, let's move on to the bond markets, because certainly that's a very interesting part of the story for 2024. So if we look at kind of just core bonds as measured by the Bloomberg Ag, we were down about 0.7% year to date. The index itself was up 0.1% for the second quarter, but still not enough to really drive us into positive territory on the first half. Municipal bonds were down 0.4% for the first half. Meanwhile, high yield bonds were up 2.6%. So the message that we've been talking through most with our clients is that we expect this yield curve inversion to normalize. The fact that short-term rates are currently above long-term rates, again, not something we expect to continue for the foreseeable future, but more of a temporary phenomenon. And that is part of what is driving our recommendation to establish longer-term portfolios with more diversified duration, and not to stick in that super short end or treasury part of the market. Speaking of diversification, we also are continuing to maintain allocations outside of the public markets, going into alternatives in private markets like private credit or private real estate, private equity. Certainly believe that that is a potential improvement to risk-adjusted returns for portfolios, gives us the ability to pursue other uncorrelated sources of yield and potential return enhancement. So with that, I thought we might drive into some of the other key factors that have been driving the markets. Can you speak a little bit about elections, geopolitical risks, and how that may come into play in the months to come?
Well, there's a lot of interesting dialogue and a lot of interesting news in front of us for the election cycle, and backing up a little, one of the things that's really key to the markets is the discussion around inflation and actions that are taken regarding inflation by the Fed. We know that we've had inflation over the past couple of years. We know price levels are much higher than they were just a few years ago. And those price levels are likely to stick right about where they are, although the increases are slowing. And the Fed seems to be winning the game. And what that has done is, as you had described on the interest rate front and the inversion of the yield curve, the entire yield curve has shifted upwards. So interest rates have risen, but short rates have risen a lot more than long rates. And after that significant rise, we have some stability now with the expectations that short-term rates will be falling. As far as other risks, geopolitical risks, they never seem to go away. And they're really not that close to being resolved when you look at the hot zones of Gaza, Ukraine, the warm zones of the South China Sea and Pakistan. And elections are a lot more fun to talk about because it's a wild card with respect to fiscal policy. And that's the other policy that we tend to ignore sometimes, especially when we are focused on what the Fed's going to do next. But to date, it's been a little bit more noise than fact so far. But we're not alone. I mean, if you pick up the newspaper or you turn on Sky News, you'll see that the UK, France, and other countries have got their own issues with regards to elections. And it comes down to fiscal policy differences between parties. The hot topics today are tariffs or taxes. And what's it going to be? And, from a federal revenue standpoint, tariffs and taxes do the same thing. They bring money into the federal government. How it's deployed is different, and it has impacts on different people in different socioeconomic and demographic regions. So it's all in the application of these fiscal policy programs.
Well, how do you expect that we may end up seeing the consumer evolve in the next 6 months, 12 months?
I think that's a great question because the consumers have been what's been driving our economy. I mean, you think about it, consumption is a little bit more than 2/3 of our economic activity. And we have employed consumers, which have been receiving great wage gains, and we have invested consumers that have been receiving increasing amounts of portfolio income because interest rates are higher now. And that all fuels consumption, which has really helped power the economy forward. And that's also powered the stock valuations to, very lofty levels. And the expectations are there for, 11 and some change to 14 and some change percent earnings per share growth over 2024 and 2025, respectively, based on productivity, margin enhancement, applied artificial intelligence. So we're at the spot where we're growing into our valuations if the companies play their cards right.
Yeah, I mean, it sounds like some of the long-term trends are in place. We're using that volatility just to get ourselves adjusting, realigning, diversifying our risk, looking at the allocations, the sectors, specific securities, the maturities. I hear you talking about the jobs machine kind of slower, normalizing, wages potentially maybe leveling off. I heard you talk about inflation continuing to come down, price stability. How about growth?
Well, the growth that's another interesting factor is economic growth for this year is supposed to be fairly subdued. We're seeing it in all the forward economic indicators, what we call the high frequency economic data. And what that means is it's not going to be a scenario where a rising tide rises all ships because it's very subdued and very, a little bit below normal economic growth. Stocks will react to earnings per share data, sales data, and at higher valuations, expect higher volatility from those stocks. Just like bonds will react to inflation data or Fed data. And behind the scenes it's a very good foundation that we have in the markets. We have decent earnings. We have expectations of good earnings growth the next 2 years. Short-term rates are expected to fall. We've got a more normalized economy, more predictable. So this time around, the porridge may be just the right temperature.
Well, thank you. Thank you for a quick summary. Appreciate the good thoughts. And again, if anyone watching has additional questions and would like to discuss further, don't hesitate to reach out to your Hoyle Cohen advisor. We'd be happy to discuss further.
Thank you.